Hello, everybody, and welcome to the final Urban Living webinar of the year. And this is the one in which we look forwards to the next 12 months and talk about some trends which we think will influence the urban living space during 2025. My name is George Sell. I'm the editor of Urban Living News, and we are an online B2B news and opinion platform for the living and flex workspace sectors. And we also organise events and award schemes. We've got a fantastic panel today to talk about the 5 trends we're going to discuss. I won't ask them to introduce themselves now, but we'll do it one by one as we get to their various trends throughout the webinar. So the webinar is going to be an hour long, and the format is slightly different from what we usually do in that rather than being a normal panel discussion, we're going to have 5 10-minute slots where we're going to do Q&As with our experts in turn as we discuss the trends. If you have got questions, you can submit them using the Q&A function in Zoom, but we're pretty tight for time today. So if you've got a question you want answered, you have to be pretty quick, and we'll try and fit it into the 10-minute segment. But if you're not quick on the buzzer, then we won't have time to do it. Everyone who's registered for the session will get an email in the next couple of days with a link to a recording of the webinar. So our first trend is about the burgeoning single-family rental market and how we might see the emergence of bespoke rental homes. And to talk about that, I'd like to introduce Richard Berridge. Richard, good morning to you.
Morning, George. How are you?
Very well, thank you. Very well. Tell us a bit about you and what you do briefly.
Well, I have a business called Blackbird Real Estate Advisory, and we work with a number of companies and individuals throughout the industry, really, but mostly focused on single-family rental. I authored Single Family Housing, the Home of Residential Investment, about 3 years ago, where we sort of looked at how it might evolve going forwards. But I also work with almost like disparate sources as well throughout the sector. So I do some stuff with BNP Paribas, sort of help them with their capital market side, particularly around single family housing. I do some work with Iterum, and I look forward to working with them on the sort of circular economy and how they sort of supply appliances. Fifth Dimension AI, fascinating this work there, working with those guys on sort of generative document flow and stuff like that, and also people like Biologic who are into smart homes as well. So right across the sector, you know, I worked with block management, single family management. I do some work on viability and feasibility studies. So yeah, pretty broad spectrum of work, and also sort of clients as well.
Yeah, thanks, Richard. Some very polished plugging for your clients there. Very okay.
Good clients.
Let's talk about the possibility for these bespoke rental homes and how we think that the single family rental sector might evolve. So primarily, the single family rental inventory out there is house builder stock, which has been sold at a discount to investors for them to operate and put in the rental market. But there's nothing to distinguish them between the for sale product. That seems to be starting to change, and we've got this Present Made, who have got quite a lot of institutional money behind them, and they are building a scheme in Cambridge, which I think is the first sort of purpose-built bespoke rental development in the country. So, Richard, what do you think will set this scheme apart from the regular house builder product in terms of the physical product, the layout, the amenities, and so on?
It's an interesting question, because this particular scheme is sort of, you know, certainly set apart from pretty much all the other single family housing schemes in the country, in a way. I mean, the first thing is that Present Made, their first ambition was to be vertically integrated, you know, to control that whole process right the way from land acquisition right way through from development and so forth. So that idea now has been dropped by them for various reasons. So it's probably not something that you're going to see in the future. Certainly not from Present Made anyway. But it's an interesting scheme because it's 373 built-to-rent units. It's often referred to as a single-family housing scheme, but in actuality, only 112 of those units there are houses. The rest are all apartments. So some 30%. So having been able to build 373 units and all in one place, they're able then to sort of build in the sort of amenity for which, say, motor living, were famed for. So they have, a gym and a cinema and other amenities, on-site management. They put in high-end furnishing, and of course that's all sort of pet friendly as well. Is it going to be a template for the future? I don't think so. Actually, in this particular, it's quite a unique site. It sort of sits just outside Cambridge in Eddington, sort of sandwiched between sort of Cambridge and the M11 to the south of it, to the west of it. So I think in many ways, you've probably sort of gleaned from what I'm saying is that if present made are not going to continue along this particular pathway, it possibly isn't the greatest viability sort of going forward. And I think that's probably the case. Houses are very, very simple entities to build. They're not complex in the same way as the build-to-rent or multifamily schemes are in urban environments, which are quite complex buildings. And need a degree of skilled individuals sort of managing them and looking after them. Houses are much simpler, but they're also easier to be made energy efficient and sustainable, and probably at a different scale or certainly at a different scale to multifamily. So the question about this particular present made scheme is one that it's actually, I'm going to struggle to see it replicated in the form that it's being delivered now anywhere else across the country. There might be. I mean, there's still a hankering, I think, of some institutions to create a premium product, and there's no doubt that this will be a premium product. So I think there's no argument about that. But in terms of the format, I think it's unlikely we're going to see a lot of these going forward. They'll be unusual.
Yeah. Okay. So in that case, let's talk about how we think the sector is going to grow in terms of inventory. I mean, we've seen a big uptick in investment in single family rental over the last couple of years, and I think it's no coincidence that has coincided with higher interest rates, higher mortgage rates, which has seen a slowdown in private sales for house builders. So it's come the growth of single family rental has come a good time for them, and they've been quite keen to sell off quite large chunks in some cases of inventory to investors. If interest rates continue to come down, and it looks like it's not going to be as quick as we might have hoped, but the direction of travel probably is down, will house builders be less inclined to sell inventory, and how will that affect the growth of the single family rental sector?
Well, we think that at the moment, I think it's pretty clear to see there's a direct correlation between the activity in the house ownership or buying of new homes market and the way that the institutions have come in to help move the stock that the house builders have already sort of embarked upon. So I think there's pretty much a direct correlation there. The question always is that going to continue going forward? If the house builders stick to their present model of delivery, then the answer to that is going to be it will change substantially and the house builders will revert to type. In an ideal world, and I suppose this is partly going to be driven by how the government's particular focus on house building, we would start to see house builders start to think about delivering on a tri-tenure basis, and that is delivering all tenures within the schemes that they are building. And it's going to be interesting to see how much of a tri-tenure model is put in place in the forthcoming NPPF. So that's going to be quite sort of interesting. There are house builders I know now who are very closely looking at how they have delivered homes in the past and how they're going to be delivered in the future. Part of their reluctance to get involved with institutions in the past and move away from what has been quite a successful model at certain times of our economic cycle is them not being particularly confident that institutions are going to be in this for the long term. I think now they're beginning to see that that probably is the case, which means that throughout the economic cycles, whether there are dips or peaks in the house ownership market, I think they're beginning to see there's a different way of delivering homes to smooth out those peaks and troughs. Some will take it up a little more avidly than others, and others will be a little slower to follow. But I think that the house builder market as a whole is probably beginning to realize that they can keep their staff, which they've trained, on their books, keep their sites open, even during times of economic sort of recession, where house ownership is reduced, or at least mortgages are not being taken up at that time. So I think that they are coming round to the idea, and interestingly enough, this year or next year, 2025, we are probably going to see a lot of them start to put together partnership models like Vistry have done, which sort of account for all aspects of their delivery.
So if this tri-tenure concept sees them, certainly on the bigger schemes, allocating a proportion of the development for a rental product, do you think that product will be different from the private sale product, and if so, how?
Well, one hopes it isn't going to be different, isn't it? But frankly, the model is different if they're selling off to a housing association. Quite often, the quality or the level of finish, let's say, is probably not as high in some of those units as it is in the ones they are selling. So you hope that they're going to be fairly consistent, right the way through. I mean, if house owners suddenly realise that the quality of the property that they had bought from a house builder was of inferior quality to that they were selling to institutions, there'd be a bit of an outcry. So probably they won't do that, although I guess the temptation is going to be there. I mean, frankly, the quality of the properties and the specification of those going to investors is very often driven by the investor. We've got to the stage now where companies like Citra, not Citra, what they call themselves now, Lloyd's Livinc, send out a specification which they expect the house builder to adhere to, and it's what they want. And particularly, it's going to be around the life cycle value of the elements within that home, because that's obviously going to have an impact on the maintenance level that they take going forward. So I suspect that what will happen is that the institutions, or the requirements of the institutions, will probably raise the standard of house building in general.
Yeah, great stuff. Excellent. Thank you, Richard, and very succinctly put and bang on time. Thank you. So let's move on to our second trend. Co-living goes nationwide. The trend for co-living, particularly on the large scale, sort of institutionally backed assets. It started in London. It's been moving out to the likes of Manchester and Birmingham, but now we're starting to see it go to tier 2 and tier 3 cities, and who knows where it might end up. If you look at the screen grabs on the slide there, you can see that there are schemes currently happening in Bristol, Cardiff, Bath, and Exeter. I'm not quite sure why the Southwest is such a hotspot for co-living. We're going to try and find out a bit more from Irene from Knight Frank. So welcome to you, Irene. Can you introduce yourself quickly, and then we'll have a quick chat about co-living.
Yeah, hi everyone. So I'm Irene. I'm a senior research analyst in the BTR team at Knight Frank, and we specialize in all three subsectors. So that is multifamily, co-living, and single-family housing. And so today I will be talking about co-living in particular. And what we do at Knight Frank, we do mostly consultancy work for clients, where our clients are normally developers. And then we also do research report for the agency and valuation teams at Knight Frank to support when they are acting on behalf of buyers or sellers. So we do research reports to sit in the data room and pitches and all that kind of stuff. And then we obviously do thought leadership through our really good editorial report.
All right, welcome. Good to have you here. So we're seeing this kind of filtering down of co-living into smaller cities across the UK. how big do you think a city needs to be to sustain one of these developments, to make it viable? And which cities do you think will become co-living hotspots that maybe haven't been had their potential tapped yet?
Mm-hmm. Right, that's a really good question. But just before answering, I would like to quickly set the scene. So what is co-living? Co-living is a form of private rental housing where people occupy private homes but share communal spaces such as kitchen and dining rooms, residence lounge, and a gym, for example. And co-living normally offers all-inclusive rent, so that provides convenience to its residents. And currently, there are almost 24,000 co-living homes across the UK. So just setting up this thing a bit. Now, going back to your question, I don't think viability for co-living depends on the size of the city. Instead, I think the growth of co-living is underpinned by a number of different macro drivers. So first is the supply and demand imbalance for rental accommodation in the UK. So we estimate that there are 1.7 million people currently sharing in urban centres across the country. However, the operational co-living supply only accounts for 9.4% of that target market. So this highlights both the opportunity and the need for development in the sector. Secondly, the demand pool for co-living is increasing due to different factors such as demographic and cultural shifts, population growth, employment growth, and obviously affordability constraints in the for sale market. So that forces people to stay in the rental sector. Now, in terms of the key hotspots, as we know, most of the operational co-living supply is located in London. However, the pipeline is expanding to different markets, with almost 7,000 units located outside of London. So which regional cities will be delivering co-living in the next 3 years? So, well, as you will expect, mostly the big cities with strong fundamentals. So these are cities like Manchester, Birmingham, Salford, and Liverpool. But as you said earlier, we are also seeing co-living homes under construction or with planning granted in smaller markets, like, for example, Woking, Brighton, Guildford, and Reading.
Okay, thanks, Irene. How do you think the product in the provinces will differ from that in London in terms of number of units, unit size, and amenity level?
Okay. Well, in terms of number of units, our data shows that in general, regional co-living schemes are generally larger than co-living schemes in London, with an average of 270 units per scheme in the regions versus 230 units per scheme in London. What we are also seeing is that the pipeline of co-living homes is bigger than homes already completed. And in terms of unit size, we are also seeing an increase, with many co-living homes now offering studios of at least 200 square feet. So moving away from the tiny homes and box rooms in previous schemes. Then in terms of amenities, well, I think that accessibility to local amenities, such as gym and co-working space, for example, plays a crucial role when deciding which internal amenities a scheme should incorporate. So these two amenities, for example, are more accessible in London than in some regional markets. So that helps to explain why the regional schemes have, on average, a higher proportion of a gym or co-working space versus London. So this is about 50% in the regions versus 30% in London.
I think one of the issues that the kind of regional growth for co-living is, one of the barriers it's up against is a lack of understanding amongst planning departments. And I think we are slowly and eventually starting to see various cities incorporating co-living into their planning standards, and we're seeing that Bristol, for example, has put together a design guide. But I think this is inevitably forcing the unit size up, because a lot of planners are, let's say, unsure about the concept. I think that's putting it diplomatically, and there's been some quite headline-grabbing quotes about co-living from planners in various cities, including Leeds, actually, which our next panelist, Zakee, his company is developing a scheme there, and I know they've had an interesting time getting through planning. Last question for you, Irene. How do you think co-living might be incorporated into mixed-use buildings and developments alongside PBSA and build to rent, for example, in regional cities?
Well, that's a really interesting question. So I totally agree with that idea, and we will definitely see that happening over time. Why it makes sense to incorporate co-living into mixed-use developments with PBSA and BTR? Well, first, because it maximizes the demand pool for the development. Secondly, there are clear synergies between the three sectors, so people can move around the different buildings, which helps with tenants' retention. So let's imagine this scenario. So I'm from Spain. Let's imagine I'm in my early 20s, wishful thinking, right? And let's say I just finished uni, I'm moving out of PBSA in Spain, and I want to move to London. So I don't know anyone in London. I don't have a job yet. So for me, it makes sense to move to a co-living scheme because I know now the benefits of renting from a professional landlord. I want to keep renting in a good quality home, and in that way I can meet people. So I moved to co-living, and then let's say a few years later, I meet someone. So we need a bigger space. So we want to still rent from a professional landlord and a good quality home. So it makes sense for us to move into a build to rent scheme, which is like multifamily scheme. And then let's say in this hypothetical scenario that we split up a few years later, then let's say I'm in my late 30s. So I don't want to house share with other people, I just want to have my own private space. So for me, it will make sense to move to a co-living scheme because then, I have my own private studio, but I can socialize with, with other people in the building and meet people. So yeah, it will make sense. And in fact, our data shows that 72% of co-living residents across the UK are aged between 26 and 40. So yeah, there is a misconception that, co-living is for young people and students, but that's not really true. Yeah, and then lastly, incorporating mixed-use development, as co-living, BTR and PBSA also helps to speed up the lease-up process. So that obviously reduces voids and OpEx cost.
Yeah, thanks, Irene. I have heard anecdotally from co-living operators that a much higher proportion of their guests than they originally expected are in their late 30s and 40s, and a lot of those are people whose family circumstances have changed and they need to find somewhere to live in a hurry. So it's an unexpected part of the demographic. That was great stuff. Thank you, Irene. Appreciate your involvement today. We're going to move on to our third trend, which will cover some similar ground to the last one, except we are jetting off to the Gulf region, and we're going to talk about the potential for the broader living sector in the Gulf. And to talk about that with me here today is Zakee Ahmed from Livinc. Zakee, good morning to you.
Morning, George.
Tell us a bit about yourself and Livinc, Zakee, before we get onto the questions.
Sure. So Livinc is two things. We're a developer and operator for flexible living spaces. As you said before, we've secured the first co-living site in Leeds. It took us around 3 years to secure planning. We secured that earlier this year, so we're really excited about that. And we have another site coming out in Sheffield as well. We've now turned towards the Gulf. I'm actually based out in Dubai. I've been here for around 6 months, and we're engaging with investors, developers, key stakeholders to release a co-living product over here, which we'll explore over the next 10 minutes a little bit more in depth. The second part of our business is where we have a flexible rental platform. So we have a platform that essentially offers monthly stays for remote workers, digital nomads, extended business travel. And on the flip side, we give suppliers and operators the means to access longer term bookings and higher value bookings, and essentially connect the two. Livinc's owned and backed by the Park Lane Group. We dabble in apart hotels through our rooms brand, PBSA through our Icon 8 brand, and a few other of the living sectors as well.
Great, thanks, Zakee. When we were at our Urban Living MEA event in Dubai a couple of months ago, we heard from several speakers about the potential for the living sector in the Gulf, and it really does feel like it's a kind of lift-off point. There's not much inventory there now, but there are a lot of people looking at it. So let's take this as a whole now: PBSA, co-living, potentially later living as well. How well are these asset classes known and understood among investors and developers in the Gulf, and what do you think is the appetite to get involved?
Sure. I like that you use the word lift-off, because I think to answer the question, we need to understand that Dubai is at a sky-high level in terms of property prices and rental rates. Not just Dubai, the region, the Gulf region, GCC. I think the region's been riding the wave for a year or two now, and it seems to keep growing. Apartment prices have gone up 20% in the first 6 months of this year alone. We're set to complete 120,000 units in Dubai by the end of 2026. And the off-plan market value has almost doubled to over 200 billion AED this year alone. So property prices and rental rates are really high. Because of that, investors and developers are very interested in what's doing well right now, and a little bit more risk averse in developing the other living sectors, which have definitely found some feet here over the last 6 or 7 years. So within the stock at the moment, we've got a very well-established build-to-sell market, which accounts for around 60% of the residential stock. That's split between two products. So you've got luxury residences, which attract high net worth individuals, foreign investors. That's around 40% of that supply. And then we've got hospitality living, sort of like a hybrid product between service apartments and extended stay hotels. That's around 20% of that supply. And that's really driven by the region's large expat population and business travel as well. BTR, PBSA and co-living are much smaller in respect to that. BTR is only around 5% of the market in the Gulf. PBSA even smaller, around 2%. There's 15,000 beds in the region at the moment, primarily between sort of Dubai and Saudi and a little bit in Qatar. Co-living and senior living, less than 1%. And I know we'll explore that further in the next couple of questions, but in respect, very, very small and very early in the stages.
It's interesting because the flip side of this real growth in the luxury for sale market and the prices going up and up and up, the population of Dubai is growing fast to service all these growing markets there. It's a very mobile, quite a young population, and these are definitely not the market for all these luxury tower blocks that are being built. So to my mind, the potential for co-living there is huge, because it seems to be a product that really fits this younger, transient, nomadic demographic. So what are your thoughts on that, Zakee?
Yeah, so 80% of the people in Dubai are expats. Coming over here for an average of 2 years. They've secured a job, or they're an entrepreneur or something similar in a similar kind of space. And their options are really rigid. They have to choose a 12-month tenancy, and they're often sort of pushed to actually pay in 2 checks for the whole year. If you're lucky, you might get 4 checks. So you're paying 3 months at a time. So there's a real appetite for flexible living from this demographic. Co-living's really early here in the sense of not many people understand it, from investors and developers to users, but there's definitely demand from the user side. From the living perspective, we've been speaking to key stakeholders for the last 6 months. We've really got good understanding as to what stage it's at. There's a few suppliers that have successfully launched schemes here, and they're doing really well. You're talking sort of 6-month wait lists, a really successful product, so great co-living features from community and facilities, resident engagement and satisfaction really high. But Dubai has all the right ingredients for co-living. It's top 3 global cities for exec nomads to live. And if you're looking at market size as a percentage of the population, we'd estimate around 400,000 young professionals and nomadic workers are in Dubai at any given time. So that gives us an idea for the kind of scale that co-living could address. In Saudi, 70% of the population is under 35. Got a really, really young population, and the government in Saudi in their 2030 vision and strategic plan is really pushing for urbanization to try and meet some of the problems and demands from this kind of demographic. Similarly, in the UAE, you've got one of the highest rates of urbanization in the world. It's 85% in the UAE. So I think it's very clear that there's a scene for co-living, and it's very clear when you look at the indicators that will keep growing. You know, it comes with its challenges as well. I think regulation and legal frameworks here are definitely moving in the right direction. Operators are not facing, I think, as such heavy resistance as we have in some parts of the UK, which I know we just covered in the session before. In the UAE and in the Gulf, you maybe got something that you don't have in the UK or in Europe as much with co-living, which is cultural resistance to a new housing model that doesn't really have a track record here, maybe isn't understood. One component of that is gender. So a lot of young professionals, let's say aged between 21 and 35, would opt for separated gender areas, from the living areas to the social areas, even the gym area. So I think for co-living, and especially for developers and operators coming from a successful model in the UK and the US, coming into the Middle East, and specifically in the Gulf, you need to be very wary of that to get that right. And on top of that, existing operators here in the Gulf for co-living are venturing into a new business model where they're engaging with housing as a service. Housing as an asset has done so well through off-plan sales and the way the market is right now. So I think if anything, there's a really exciting space there for a great synergy for operators that have proven that they've got the successful blueprint for co-living, and players in the space in the UAE who understand everything else within the market to come together and provide a great product here.
Yeah. And on a similar note, Zakee, one last question for you. Heartland Group has a student brand here in the UK. It seems to me that the UAE has become a hub for higher education very rapidly. I think the presentation we saw about Sharjah recently said there were 15 universities in Sharjah alone. So what do you think, briefly, is the potential for the PBSA market in the Gulf region?
Yeah, I think co-living and PBSA kind of running at a similar rate at the moment. Co-living is earlier on in the journey. My personal opinion would be that co-living may actually outpace PBSA, just because of the addressable market. But PBSA is a really exciting time. When we've been speaking to investors and developers, they understand the PBSA products really well, and there's been a clear need for that for a long time. As you said, you know, there's more universities in the region. There's more international universities establishing a flag here. Certain countries are also dedicating areas to education. For example, in Dubai, in Qatar, you have Qatar's education city. So they're really building up the hub to not only have the uni, but to also have residences. When you look at the data, 80% of students in Dubai lack access to a purpose-built student accommodation style product. Again, similarly to co-living, I think we have to look at the cultural side. Especially for students, you know, around sort of 18 years old, there is, again, a preference to not only be separated for gender, but also to maybe be at home with the family and not to be living in their own space. So I think PBSA products here will target more of the expats and international students coming into the region, which is very different to what we have in the UK because we have strong products on both sides. So I think, again, players will need to take that into account. Again, when you look at the data, we can see that Dubai is projected to grow the PBSA stock up to 25% over the next 5 years. So there are things in the pipeline. Regulation is positive, and I think developer and investor sentiment is more advanced than co-living at this stage.
Brilliant. Thank you, Zakee. That's a great summary. Thanks very much.
Thanks, George.
Let's move on to trend 4. And we are going to talk about amenity-light build-to-rent and PBSA and the potential for that to grow. And to talk about that, I'd like to welcome Debra Yudolph. Hi, Debra. Would you like to introduce yourself?
Hi, George. Thanks for inviting me onto the webinar. I'm Debra. I'm the CEO of SAY. We're strategic operational advisors in the living space, and that obviously includes build-to-rent, PBSA, single-family housing. We work with developers and investors and often look at assets that are being delivered. And then more recently, probably also support investors looking at existing assets and helping them to review the performance of them, really driven by some assets, aging, sort of getting to 7 to 10 years old, cost increases and challenges on delivering an expected net operating income. And then also just I think that there's existing assets that are being brought to the market as well. So just reviewing performance. So that's a shift that we've seen. And then we also have a mystery shopping business called Hearsay, which mystery shops the lead to lease experience in build to rent. And we have a benchmark of performance that we publish, and that will be out in February.
All right, thanks, Debra. So if you were to go on property tours of a lot of build to rent stuff in London and Manchester, you would see very highly amenitized, very sophisticated buildings with a kind of hospitality element to them. But obviously this product isn't for everybody. Cushman and Wakefield recently published a report which highlighted that amenity-light build to rent is becoming increasingly popular among investors. Why do you think this is, Debra, and what do you think is the potential for growth of this type of product?
Yeah, so going back to a bit about what I just said, actually, I mean, yes, you're right. If you go out and look at build to rent, then generally it's amenity heavy. We've certainly over the years seen a sort of race, an amenity arms race, where amenity got bigger and bigger and more varied, and that's really attractive to people that are living in the building. It's not all like that. I mean, there are people in the industry that do deliver much lighter amenity space. But as one of my clients said to me the other day, is this really build to rent because it doesn't have a gym? So I think that there is a perception that that's what build to rent is. I think that it's always sat at the top end of the market, so definitely in the top 25% quartile on price, if not higher, in the location that it's in. And there's also been not a lot of variety in the approach to amenity, where the local surroundings and the local sort of amenity offer has been taken into account. I think the driver interestingly for investors being interested in amenity light is to achieve the operating income that they're looking for. And obviously some amenities, not all amenities, but some amenities are quite expensive to operate, but probably more importantly are taking up space that could be used for additional apartments. So they're reducing the overall potential rental income, and they're also capital intensive in respect of the cost of delivering them. So I think it's there's three aspects to the interest in lower amenity, but I also think it's just about the industry growing up a bit and understanding the performance of buildings, what's used, what's not used, and also challenges around affordability, because arguably if you are improving you're improving the density of units and you're reducing your operating costs, then you potentially you can offer a more mid-range rental offer.
Yeah, it's interesting the line you said about if this doesn't have a gym, is it built to rent? What do you think a built to rent building does need to include amenity wise to, what's the sort of bare minimum to
what
fit
makes
within that?
What makes it build to rent? Well, I mean, this is, So, I mean, this project is quite interesting because it includes a fair amount of affordable, and it's right next to a station, and it's, you know, there are 3 gyms within, you know, a few minutes, and it's quite a tight site, and it's difficult to get the number of units that it needs in order to achieve the financial requirements. So I don't think that I don't think something has to have anything particularly. I think it's really important to understand in the specific location what's needed and what will deliver the best financial performance. And I think that that's where the industry is perhaps growing up a bit and understanding that it's not one size fits all. It's very location specific. I also think that when we talk about amenity, we're also talking about service. And so, you know, can you have build to rent with poor quality operational service? No, absolutely not. Can you have build to rent without a gym? Yeah, absolutely you can, because you need to deliver the amenity that is right for that specific schemes. And we are seeing maybe some smaller schemes as well. So it just makes it more difficult to deliver the range of amenity that we might see. I think typically we would say that that co-working is probably at the moment, the most important space that people want. And again, it depends on the location of the scheme, but we know that people are working from home. We know that that the 1-beds are often generally occupied by couples, and therefore working from home as a couple and both finding space to do that is really difficult. And so that co-working space is you know, it's really valuable and it's seen as a real attractor. We think that co-working space doesn't have to be operated as part of the build to rent scheme. There's some great examples. There's a business called ARC that puts in a sort of community facing co-working offer that the residents get to use, and it's a much, you know, it's a vibrant, it's designed as co-working as opposed to a sort of flexible co-working lounge type space. So I don't think that it always has to be a cost to the operator. It can be income producing as well. And again, that needs to be really specific to what the ground floor uses are. It can really create a sort of enlivened ground floor use. So I think that you need to start at the top in respect of what's needed, and then work out how you can deliver it in the best way possible for you know, for us, for the clients that we're working with.
Yeah. One of the things we've seen over the last few years, Debra, is a lot of buy-to-let landlords leaving the market. These are people who, you know, would have had a handful of properties and they would rent them to students or to young professionals mainly.
Yeah.
It seems to me that currently the bulk of the build to rent and PBSA offer that we're building and that's in the pipeline is not addressing the people who were being served by those landlords, and that this sort of amenity arms race that you referred to has priced out a lot of potential customers. Do you think the build to rent and PBSA sectors will have to place more emphasis in future on addressing the affordability issue and providing offer for a broader kind of income spectrum of tenants?
Yeah, I think that, I mean, just from a housing need perspective, I think that there's clearly a need and a demand for more mid-market housing. And with people not being able to get on the housing ladder in lots of locations, there isn't really a suitable, particularly with the reduction in other rental housing, there isn't a suitable offer, and we all know how difficult it is for people to rent. Whether that will be delivered at scale, I think is debatable because of the viability of it. But I think that we will see, sorry, I'm going to cough. We will see more discount market rent and sort of mid-market housing mixed in with build to rent. And I do think we will see more amenity-light housing, but I don't think it's going to take a long time to deliver at any scale. Sorry, I just need a drink.
No problem. Thanks, Debra. We'll let you call it there, but thank you. That was some great.
It's okay now.
Nice talking to you. Okay, let's move on to our fifth and final trend. We've spoken a lot about accommodation and actually the link between accommodation and work, and now we're going to talk about workspace with Lisa Cations. Lisa, would you like to introduce yourself quickly?
Absolutely, and thanks for having me. Lisa Cations, I'm the founder and managing director of JCR Advisors. That's a boutique consulting and asset management firm. So I've been advising investors, landlords, and operators, landlords and fund managers specifically, on how to select co-working, flexible office operators, and the operators around their growth strategies and how to make a commercially viable business model. And my business has evolved exactly sort of in line with the trends that we're just going to be talking about, from advising the landlords on what operators to select into their schemes, all the way to how to deliver flex and co-working using their internal resources. And that's a very interesting dynamic in the market, as we are seeing more and more landlords now adopting flex. Quite a significant amount of those property owners are interested in setting up their own operations, white labeled, retaining their brand and having full control of their customer and products and relationships. So yeah, we'll talk about this, but that's in short the introduction of my company.
All right, thank you, Lisa. So picking up on one of your points there, there was a recent survey which found that around 10% of UK office landlords are predicting that their portfolio will be almost entirely made up of flex workspace by 2030, up from around 3% currently. Does this tally with what you're seeing in the market at the moment?
Well, I am seeing quite a significant growth in terms of the realization first of the trends. So around sort of 87% of the landlords acknowledge that there is the massive flex demand and the evolving workplace patterns, and therefore they are trying to adopt their strategies to meet much bigger sort of demand from the tenants, the occupiers, and individual members. But I do question this number, and the reason for this is the capital markets state of things. So if you have an office building that is fully operated as a flexible office pattern, you will not get much of the upside when you sell the building. So there's very much a disconnect between the increase in rental growth and absolutely the premium that the landlord can achieve if they allocate all the space to flexible office operations. But if they hold the asset for 3 or 5 years, they can't really realize the capital return because the market and the valuations are not reflecting the actual sort of value attached to this building if it's fully led to the flexible operator or is operated by the landlord themselves on a flexible term basis. So I am questioning this number, to be honest. I do see the trend in terms of growth in adoption of flex, but some of the studies by CBRE, for example, reflect that around sort of 10 to 20% of the building allocated to flex is not detrimental to the valuation, but anything above that percentage is actually triggering the discount in the event of sale. So that's where I think the market needs to evolve, and hopefully with the more transactions of the buildings where the flex will have a more prominent role to play, if there is an upside that the investors will be willing to pay, this will then translate into valuations and hopefully bigger adoption of flex. But as we stand, I believe that 10-20% share of the building allocated to flex is what we're going to see.
That's really interesting. Why do you think there is this variance between valuations of flex and, let's say, for want of a better term, traditional office? Is it because investors are still a bit jittery about flex, or they don't fully understand it yet?
Yeah, so I think investors are starting to understand more and more. I think if we make the comparison with the hospitality industry, and I know that leaving the PBSA sector, it took a while to convince the investors in the business model and how to even underwrite the risk. I think in the flex sector, there's such a variety of different products and different terms used where, you know, even during this webinar, we used the term co-working, then you have flex, then you have managed offices, serviced offices, and there's not really a standardized understanding in the market of how to even look at the profitability growth and projections of a certain product. So I do think that lack of data, lack of historic trends, and understanding, again, like in the hospitality world, you have STR, you have very transparent market information where the investors can see on the business level how the operator is performing, what's their long-term kind of performance, the sales, the occupancy data, and then they can actually forecast certain revenue projections. In the co-working flex managed offices world, the information is not really that transparent to really assess the business performance of an operator and to understand how much of a risk is attached to this cash flow. So the way the values are now approaching this, they're looking at all this space as almost, you know, they value it as vacant possession. So they assume that those short-term license agreements, they're not reliable enough. They're looking at the longer term as more secure income stream, even though you can absolutely debate that because you have diversification of the tenant base, and therefore, you know, your rental profile, if you have a major tenant leaving and the void period of, let's say, 6 or 12 months is a major sort of your risk, but somehow the longer term larger tenant is considered to be more secure than having the flexible office operations with 6 to 12 month average lease term, with quite a lot of sort of velocity of the tenants and lack of transparent business performance.
Do you think that the well-publicized problems that WeWork had is still casting a shadow? Is that still in the back of investors' minds?
Yes, absolutely. And there's a lot of heartburn because of the, you know, the leases that were surrendered by WeWork, and, you know, the WeWork are not the first player in the markets. IWG also, you know, experienced this during the downturns in the past. So I think, yes, absolutely, there's a lot of sort of risk attached to that. But I think it didn't prevent or stop the investors from sort of adopting flex. What it changed is the dynamic from them looking at selecting an operator versus embedding flex in their operations and delivering it themselves. So you can look at Great Portland Estate. They've launched a massive sort of proportion of their space allocated to managed offices. You can see Landsec with Mayo, British Land with Space Story. There are a lot of landlords who are now more and more adopting this model. So I think it doesn't shy them away from the sector as such, but it does create an alternative view on how to deliver space. And rather than going with the operators like WeWork or IWG, there's definitely an alternative for the landlords to deliver flex. And that's what I'm doing in my business engagements day to day, where I'm advising how to set up flex using their own resources and actually upskilling their property management team, facilities management, leasing teams, front desks, so that their existing teams are operating with a more custom service lens in mind and more commercially minded as well.
Yeah. One last question for you, Lisa. One of the screen grabs you can see on the slide there is a story that we've run recently on Urban Living News. US insurance company Allstate is going to move around a quarter of its 54,000 strong workforce to flex office premises. I think, if I remember rightly, it's any office. Any city where they have less than 1,000 employees, they're going to put into flex workspace. Is this a strategy that is going to become the norm for blue chip companies, do you think?
Yes, absolutely. You know, I've run in my past a number of enterprise sales teams for Industrious, for HANA, and for IWG Regis and Spaces, and I've seen this on a day-to-day basis. We were dealing with Amazon, who sort of announced their back-to-work strategy, but their head office didn't have enough capacity to accommodate the people coming back, so they had to come into the markets, procuring the flexible office space. There are a number of other companies that adopt hub and spoke models. So you do have the head office that is absolutely your home, most probably on the long-term lease, and then people are offered the choice to work near where they live, and are given complimentary passes to the co-working or flexible office spaces, so that they can use wherever they live, reducing the travel to the head office. So absolutely, these are the ways for them to reduce costs, to increase the engagement, and also hiring of the talent. Some of the examples when the company, actually Allstate, when they announced that they would offer this choice, the number of applications from female talent and of color, talent of color increased, because this allowed them to actually create more socially equitable environment, and people had no choice to work in different flexible office and flexible timing patterns. So I do think that there is absolutely demand, but I do want to highlight one of the much bigger trends which we're seeing in the UK. There are a phenomenal number of businesses created in the UK, with the number of employees less than 49 employees per company. So in last year alone, there were 900,000 businesses created, with very much small number of employees, and those companies are not even employing other talent. So they're more solopreneurs, they're more people working kind of in a more agile fashion, digital nomads, etc. So what I want to highlight is that we're talking a lot about sort of Allstate, HSBC, Amazons, and the likes. The majority of the demand is coming from those smaller companies, less than 49 employees, that represent 99% of the businesses in the UK. And those companies procure in a different way. They buy the products in a different way. They use the products in a different way. And this is back to Debra's and Irene's point about the co-living trends, about the amenities. Co-working becomes such an integral part of the living sector as well, because people want to work near where they live, and this is becoming such a big trend, where we're seeing a significant increase in the co-working companies going into PBSA, going into co-living properties, where the landlords and developers can achieve 25% increase on the residential rental by placing co-working in their schemes. And there's absolutely the pent-up demand for that. And we're also seeing IWG, for example, the largest co-working and flexible office operator in the world, increasing their presence in the regional cities and the more suburban locations. So there's definitely demand both from the large companies like Allstate and HSBC, but there's much bigger demand from smaller companies and individual entrepreneurs.
Brilliant. Thank you, Lisa. Great stuff.
Thank you.
All right, we've covered a lot of ground today, and a lot of food for thought, but I've really enjoyed it. I think it's been a fascinating session. Just wanted to show a couple of quick slides before we wrap up. These are the topics for our H1 Urban Living webinars next year, and as you can see, some of those will touch on the topics we've covered today. The first one is on February the 7th, and we'll be looking at the living sector's role in addressing the housing crisis, lack of stock, affordability, and so on. There are a huge number of issues there. If you'd like to register for any of those webinars, you can see the links in the chat. Just wanted to briefly mention our Recharge event, which is taking place in Porto next month on the 27th and 28th of January. This is a great event which looks at urban development, real estate, hospitality trends. It moves around to a different European city every year. We started in 2018 in Amsterdam. We've been all over Europe since, and we're back in Portugal at Porto in January. The link to find out more and buy tickets is in the chat. It's a really good event. I'd love to see some of you there. If you'd like to work with us here at Urban Living News or any of our other brands on our digital or in-person events, please get in touch with my colleague Piers, whose details you can see on the screen and also in the chat. And finally, I just wanted to say thank you. Thank you so much to Lisa, to Debra, to Zakee, to Irene and Richard for their contributions today. Thanks to you for watching. Thanks to everyone who's contributed to this webinar series over the course of 2024. We've had, I think, something like 8,500 people registered for the Urban Living webinar since we started them. And they've been a great way to keep in touch with our audience and keep up to date with trends. And I really hope you've enjoyed them. I'd like to see plenty of you on sessions in the new year. So as I say, the first one is on February the 7th. Have a good Christmas, everybody, and we'll see you in the new year. Thanks very much.